To fully understand the business, you need to know the language of numbers. In our case, to understand the financial statements of companies. The financial statements consist of three parts: report on financial results, balance sheet, cash flow. We'll start to analyze the main points of the report on financial results using the example of Apple, using the website The Wall Street Journal, WSJ.com. Revenue: the income that the company received from entrepreneurial activity is calculated before deducting any expenses. Cost of goods sold, COGS, including D&A is the cost of goods sold, which refers to the direct costs associated with the production of goods. This amount includes the cost of materials used to create the goods, as well as direct labor costs used to produce the goods. In this case, depreciation is also taken into account. Gross income is the difference between revenue and the cost of goods sold. SG&A expenses are general, commercial, and administrative expenses. This includes expenses not directly related to the manufacture of the product or the provision of services. That is, SG&A expense includes the costs of selling and shipping products or services, in addition to the costs of managing the company. In addition, this includes rent, utilities, and consumables that are not part of production. SG&A expense includes almost everything that is not included in the cost of goods sold. EBIT is net profit before tax and interest on debts. But this line should contain operating income. It is not known why the editors decided to write EBIT here, because the indicated value corresponds to operating profit. Okay, let's imagine that this line shows the operating profit, which in turn means the profit received from the main activities of the company. Her calculation is to subtract from gross income SG&A expense interest expense, the cost of paying interest on the debts of the company. Pre-tax income, profit before tax. To get its value, add the amount, non-operating interest income plus interest expense, to the operating income, and the non-operating income expense value. Income tax, the amount of tax paid. Net income, EBITDA is profit before tax, interest expense and depreciation. The first section is assets. This section includes all the resources owned by the company, expecting that they will bring profit in the future. Cash and short-term investments are cash and short-term investments that are quickly traded assets. Total accounts receivable is a receivable, usually a short-term debt of a company, in the person of those who may be owed to the company. Clients themselves or other enterprises may act. Inventories is a term for finished goods available for sale and raw materials used to produce goods available for sale. Total current assets is the sum of all current assets, cash and cash equivalents, stocks, accounts receivable, and other current assets. Net property, plant and equipment is the net worth of fixed assets, that is, all the buildings, land, furniture, and other physical capital that the company acquired to conduct business. The term net means that accumulated depreciation expenses are deducted from the value of fixed assets. For example, suppose a company buys a building worth $1 million, along with furniture for $50,000. Their net fixed assets at the time of purchase are $1,050,000. However, each year the company must reduce the cost of these fixed assets in order to take into account the fact that they are worn out and require repair or repurchase in the future. Assume that in the first year, the company depreciates buildings and furniture by $105,000, or 10% of the initial cost. Then, at the end of the year, net fixed assets will be $945,000. Total assets, the sum of all assets. The second section is liabilities. This section includes all sources of cash used in the formation of the company's assets, liabilities, and equity. Saint debt and current portionality debt is the sum of all current debts of a company with a maturity of less than 1 year from the balance sheet date. Accounts payable is the amount that a company must pay suppliers for services or products that it purchased on credit. Total current liabilities is the total amount of current liabilities with a maturity of less than 1 year. Long-term debt is the sum of all long-term debts of a company with a maturity of more than 1 year from the balance sheet date. Total liabilities, the sum of all obligations. Total shareholders' equity, the difference between total assets and liabilities, also referred to as equity or net assets. It includes common stock par carry value. Usually, when issuing shares, they indicate a very insignificant value, for example $0.0001. But in this situation, the difference between the nominal value and the sale price is indicated. The amount received during the issue and sale of shares may be found in the additional paid-in capital article. Retained earnings is the accumulated net profit of a company that has been invested back in the business. Treasury stock are previously issued shares of a company that were repurchased but not redeemed. They can be sold again, redeemed, or left on the balance sheet. A company can leave shares on the balance sheet, for example, to remunerate employees or to form a new stock that can guarantee that no one else will collect a controlling stake. No dividends are paid on treasury stock. They have no voting rights, and no profit or loss is distributed on them when calculating net earnings per share. Treasury stock is deducted from retained earnings when calculating equity. As you can see, the company does not have treasury shares on the balance sheet. Liabilities and shareholders' equity is the total liabilities of a company. Operating activities is a section indicating the amount of money a company receives as a result of ongoing regular business operations. Net income before extraordinaries is net profit before extraordinary events. Depreciation, depletion, and amortization, the size of depreciation deductions. Net operating cash flow is an element that includes the cash inflow and outflow of a company from its core business. The investing activities section is a section that reports on the profit or loss from investments and the amount spent on investments in fixed assets. Capital expenditures or capital expenditures, commonly known as CapEx. These are the means used by a company to acquire, modernize, and service physical assets, such as property, buildings, industrial plants, technologies, or equipment. Capital expenditures on fixed assets can include everything from repairing the roof of a building to purchasing equipment and building a new plant. This type of financial cost is incurred by the company to maintain or increase the volume of its activities. Purchase-sale of investments is the sum of expenses on investments and income from the sale of previously made investments. Net investing cash flow taking into account all income and expenses from investment activities. Financing activities is a section of a company's cash flow statement that shows the cash flows that are used to finance a company. Financial activities include operations with debts, stocks, and dividends. Cash dividends paid is the amount paid in the form of dividends. Change in capital stock, the amount of income from the sale of shares and the cost of their repurchase. Issuance of long-term debt, the amount taken as long-term debt. Reduction in long-term debt, the amount spent on the return of long-term debt. Net financing cash flow, net financial cash flow obtained by adding all the income and expenses in this section. Net change in cash, a net change in cash on the company's balance sheet. Free cash flow obtained by adding the operating cash flow to capital costs.